Introduction to Warren Buffett's 7 Rules for Successful Investing. The 7 Principles of Warren Buffett's Successful Investing. Warren Buffett's investment philosophy, and his rules of investing to make money. This is how the world's favorite billionaire can help. Want to see more content like this? Then make sure to like, comment, and subscribe, and check the links in the description. Warren Buffett, one of the most successful investors of all time, has not been discouraged by the increase in the cost of fighting Ebola. During these turbulent times, Berkshire Hathaway's chairman has been somewhat quiet, but this does not mean he has been particularly vocal elsewhere. He hasn't been seeing great opportunities, even during the current recession. He stated to investors at the 2020 annual meeting of BRK.AB, "It's not because he is afraid." He stated, "We have not done anything because we do not see anything that is that appealing to do." Still, Buffett is as sharp a thinker as ever as he gets closer to his 90th birthday in August, and he hasn't said he will retire anytime soon. And why ought he to? Investors have been rewarded with an average annual return of 20.5% ever since Berkshire Hathaway began trading publicly in 1965. Do you want to know how he did it? Investors can learn how to build a portfolio that beats the market by looking at how he invests. You can learn 7 things from Buffett that will help you succeed. 1. Maintain discipline when purchasing businesses is one of the most important principles that Buffett adheres to. He sticks to his rules and makes his own. The billionaire asserts. You will notice that we have relatively few major equity holdings. We choose such investments with a long-term perspective and take into account the same factors as would be used to acquire 100% of an operating business. 1. Favorable economic characteristics over time. 2. Management that is competent and sincere. 3. An appealing purchase price when compared to a private owner's standard of value. And 4. A sector of the economy with which we are familiar and whose long-term business characteristics we believe we are qualified to evaluate. One reason for our concentration of holdings is that investments that pass this test are hard to find. Over the course of his career, Buffett has maintained the discipline to avoid purchasing businesses that did not meet the aforementioned criteria. We simply cannot locate 100 distinct securities that meet our investment requirements. Nevertheless, we are content to concentrate our holdings on the much smaller number that we do find appealing. 2. Purchase what you know. Buffett has broadly said, never put resources into a business you can't comprehend. This does not imply that you should steer clear of an investment because it is outside of your expertise. However, you must be able to accurately value it. Avoid a company whose operations fall outside of your expertise. As Buffett said in his 1996 investor letter, an investor needs to be able to accurately assess particular businesses. Take note of the word selected. You do not need to be an expert on each and every company. You only need to be able to evaluate businesses that are in your area of expertise. The diameter of that circle is of little significance, but it's important to know where it ends. Financial stocks like Wells Fargo and consumer discretionary stocks like Coca-Cola are in Buffett's area of expertise, which is why he was reluctant to invest in technology stocks for a significant portion of his career. However, on May 15, 2016, he made the move and paid $108.99 per share for 9,811,747 Apple shares. Apple closed at $307.71 on May 15, 2020, and 182% increase in share price. Not bad for someone who initially refused to invest in technology. 3. Keep your cool as an investor, according to Buffett, and don't buy into the market's emotions. Keep in mind that the stock market is a manic-depressive disorder, he advises. This can be accomplished by purchasing excellent businesses with solid fundamentals and focusing on the long term. There are many reasons why markets will rise and fall, but the majority of declines will be relatively brief. It's critical not to get manic-depressive when the markets are going up. You accomplish this by focusing on the future and ignoring fluctuations in the market on a short-term basis. Gotten this far into the video? Make sure to like, comment, and subscribe, and check the links in the description. 4. Open the door. Buffett wrote in his 2016 shareholder letter, "When opportunity knocks, open the door." The economic sky will be filled with gloomy clouds about once every decade or so, and they will briefly shower gold. It is imperative that we rush outside carrying washtubs rather than teaspoons when such downpours occur. Do you remember the adage, buy low, sell high, from the stock market? There will be numerous opportunities for you to acquire excellent stocks at bargain basement prices if you are patient. One reason to ensure that a portion of your portfolio is cash-based is so that you can take advantage of a temporary fire sale. 5. Invest for the long term. According to Buffett, investors ought to have the impression that they are a part owner of the businesses they purchase for their portfolios. Your goal as an investor should simply be to purchase, at a rational price, a part interest in an easily understandable business whose earnings are virtually certain to be materially higher 5, 10, and 20 years from now, he wrote in a letter to investors in 1996. The best way to build wealth is to hold on to it for a long time. Don't even think about owning a stock for 10 minutes if you haven't owned it for 10 years, Buffett advised. 6. Index funds are an investor's best friend, and Buffett is a big fan. In fact, he has instructed his trustees to receive 90% of his wife's inheritance upon his death. In his shareholder letter for the year 2013, he stated, "My recommendation to the legal administrator couldn't be more basic. Keep 90% of the cash in a low-cost S&P 500 index fund and 10% in short-term government bonds. I recommend Vanguard's. The trust's long-term outcomes from this policy will, in my opinion, be superior to those of the majority of investors who employ high-fee managers, whether they are pension funds, institutions, or individuals." He emphasized that exhortation at the 2020 yearly gathering, owning an S&P 500 index fund, in my opinion, is the best option for the majority of individuals. 7. Even though Buffett has repeatedly stated that he invests for the long term, he is not afraid to sell losing stocks if the fundamentals have changed and he is no longer optimistic about an industry. This was the situation when he sold Berkshire's $4 billion position in the airline industry in April, when the coronavirus pandemic was wreaking havoc. What made him sell? The Oracle of Omaha stated, "For airlines, the world has changed. I also have no idea why it has changed, but I do hope that it will correct itself fairly quickly. Due to the extended period, I am unsure whether Americans have changed or will change their habits. Indeed, even extraordinary financial backers commit errors, yet you should perceive when you've made one and escape the venture before it makes much further misfortunes. These insights aren't guaranteed to help you earn an average annual return of 20.5% on your investments over the long term. Be that as it may, they could try and return more assuming that your circle of capability is in development stocks in the innovation field. However, following Buffett's guidance can set you up for a very successful investing career. Thanks for watching this video. Make sure to like, comment and subscribe, and check the links in the description.